Hello everyone. In this video, we will solve 30 advanced exam-level questions from investment theories in macroeconomics, including ideas from John Maynard Keynes and James Tobin. Each question comes with a clear and smart explanation to help you prepare for exams. Let's begin. Question number 1. A firm expects a machine to generate returns of 12% while the market interest rate is 8%. According to the marginal efficiency of capital theory of John Maynard Keynes, the firm will A. Reduce investment. B. Maintain capital. C. Invest in the machine. D. Sell capital. Answer: C. In MEC theory, firms compare expected return with the interest rate. If expected return interest rate, the investment is profitable, so the firm invests. 2. If the expected rate of return from capital falls below the interest rate, firms will A. Increase investment. B. Stop investment projects. C. Increase savings. D. Increase employment. Answer: B. When return interest rate, the cost of borrowing is higher than profit, so firms cancel or delay investment. 3. Production rises from 200 to 260 units. Capital output ratio equals 3. According to the Accelerator theory, investment equals A. 120. B. 180. C. 150. D. 90. Delta y equals 60. I equals lambda delta y is equal to 3 times 60. Answer: B. Accelerator theory says investment depends on change in output. Higher output growth requires more capital, increasing investment. 4. According to the Accelerator principle, investment depends mainly on A. Interest rate. B. Change in output. C. Population. D. Government spending. Answer: B. The Accelerator model states that firms invest when demand or production increases, because they need more machines and equipment. 5. If output remains constant for several years, the Accelerator theory predicts A. Increasing investment. B. Zero net investment. C. Negative investment. D. Rising capital demand. Answer: B. If output does not change, firms already have enough capital. Therefore, no new capital is needed, so net investment becomes zero. 6. A company uses retained earnings to buy new machines. This behavior is explained by A. Tobin's Q theory. B. Internal fund theory. C. Accelerator theory. D. Neoclassical theory. Answer: B. Internal fund theory says firms prefer using internal profits instead of borrowing because it avoids interest costs and financial risk. 7. According to internal fund theory, firms with higher profits will A. Borrow less and invest more. B. Borrow more and invest less. C. Reduce investment. D. Increase taxes. Answer: A. Higher profits provide more internal funds, allowing firms to finance investment without external loans. 8. Market value of a firm equals 500 million bear, replacement cost equals 400 million bear. According to the theory of James Tobin, Tobin's Q equals A. The 0.8. B. A 1. C. 1.25. D. A 2. Q equals 500/400. Answer: C. Tobin's Q compares market value of a firm with cost of replacing capital. 9. When Tobin's Q greater than 1, firms will A. Reduce investment. B. Expand capital stock. C. Sell assets. D. Stop production. Answer, B. If market value is greater than replacement cost, building new capital becomes profitable, so firms increase investment. 10. If Tobin's Q less than 1, firms will likely A. Increase investment. B. Avoid new investment. C. Increase production. D. Increase wages. Answer, B. If market value is less than capital cost, new investment is not profitable. 11. According to the neoclassical investment theory, firms invest until A. Profit equals revenue. B. MPK equals cost of capital. C. Output equals demand. D. Saving equals investment. Answer, B. Optimal investment occurs when marginal product of capital equals the real cost of capital. 12. If MPK increases while interest rates stay constant, investment will A. Decrease. B. Stay constant. C. Increase. D. Become negative. Answer, C. Higher MPK means capital becomes more productive, so firms invest more. 13. A fall in the real interest rate will A. Decrease investment. B. Increase investment demand. C. Reduce capital productivity. D. Reduce savings only. Answer, B. Lower interest rates reduce borrowing costs, encouraging firms to invest more. 14. Which factor shifts the investment demand curve rightward? A. Higher taxes. B. Technological improvement. C. Higher interest rate. D. Economic recession. Answer, B. Better technology increases expected profits, encouraging firms to invest more. 15. A sudden increase in demand for products will likely cause A. Lower capital demand. B. A higher induced investment. C. Lower inventory. D. Higher unemployment. Answer, B. Higher demand requires more production, so firms invest in new machines. 16. If depreciation is greater than gross investment, the economy experiences A. Capital growth. B. Net investment. C. Capital consumption. D. Economic expansion. Answer, C. When depreciation exceeds investment, the capital stock declines. 17. Which represents inventory investment? A. Building a new factory. B. Buying bonds. C. Increasing stock of finished goods. D. Hiring workers. Answer, C. Inventory investment refers to goods produced but not yet sold. 18. A firm stores extra raw materials to avoid delays in production. This is A. Financial investment. B. Inventory investment. C. Public investment. D. Fixed investment. Answer, B. Firms hold inventories to maintain continuous production. 19. Unexpected rise in demand may cause firms to A. Reduce inventory. B. Increase inventory investment. C. Stop production. D. Reduce prices. Answer, B. Firms build inventory to meet higher demand quickly. 20. Which theory focuses on future profit expectations? A. Accelerator theory. B. Keynesian MEC theory. C. Internal fund theory. D. Inventory theory. Answer: B. MEC theory states that investment depends on expected profitability. 21. If firms expect a recession, they will likely A. Increase investment. B. Maintain investment. C. Reduce investment. D. Increase wages. Answer: C. Poor future expectations reduce investment spending. 22. A rise in corporate profits strongly increases investment according to A. Internal fund theory. B. Tobin's Q theory. C. Accelerator theory. D. Classical theory. Answer: A. Higher profits provide internal funds for investment. 23. In the accelerator model, falling output leads to A. Negative investment. B. Higher capital demand. C. Stable investment. D. Rising employment. Answer: A. When production falls, firms need less capital, causing disinvestment. 24. Which theory links stock market value with investment decisions? A. Accelerator theory. B. Tobin's Q theory. C. Keynesian theory. D. Classical theory. Answer: B. Tobin's Q uses stock market valuation to explain investment behavior. 25. If new technology greatly increases productivity, investment will A. Decrease. B. Stay constant. C. Increase. D. Become negative. Answer: C. Higher productivity increases expected returns from capital. 26. A large rise in interest rates will likely cause A. Higher investment. B. Lower investment. C. Higher productivity. D. Higher consumption. Answer: B. Higher interest rates increase borrowing cost, discouraging investment. 27. Which theory explains investment as derived demand from output growth? A. Tobin's Q theory. B. Accelerator theory. C. Internal fund theory. D. Classical theory. Answer: B. Investment increases when output demand increases. 28. Cost of capital mainly includes A. Wages. B. Interest rate and depreciation. C. Population growth. D. Taxes only. Answer: B. Cost of capital includes interest rate, depreciation, and capital price. 29. Rising stock market prices encourage investment according to A. Accelerator theory. B. Tobin's Q theory. C. Internal fund theory. D. Keynesian consumption theory. Answer: B. Higher stock prices increase market value of firms, raising Tobin's Q. 30. Which investment type helps firms maintain smooth production? A. Public investment. B. Fixed capital investment. C. Inventory investment. D. Financial investment. Answer: C. Inventory allows firms to avoid shortages and production interruptions. That's all for today's 30 investment theory questions from Macroeconomics. If this video helped you, please like, subscribe, and share with your classmates. See you in the next econ.